Okay, good morning and a warm welcome to you all. Great to have you here again for our final webinar of this week, which is looking at demystifying the tax implications of the current crisis, but also looking at some other broader tax issues that have direct impact on SMEs. So I'm delighted to have you with us again. It has been a very busy week with our bonus webinar. So great to see so many people engaged throughout all of this series. Our speakers today, I'm really excited to introduce. Personally, I'm a big fan of both of these people. So Tom Maguire, tax partner at Deloitte, is going to deliver our keynote this morning. And Tom, it's fair to say, well, I'm going to say it anyway, even though he'll probably give out to me, is one of Ireland's leading authorities on tax. He wrote the book on Irish corporation tax, Irish capital gains tax, and Irish income tax. He will come in now, no doubt, to tell me that he took over a few of those, but he is somebody who is held in much high regard in terms of knowing his stuff, shall we say. He also writes a weekly column you may be familiar with on the Sunday Business Post, a regular contributor there. And he is going to talk to you today about some of the key issues in relation to the current crisis. And followed by that, we're going to have Paula Byrne deliver a session. And Paula is a dear friend and colleague of mine. She lectures the tax module on our Masters in Accounting and Finance Management. And she has her own practice, Paula Byrne Accountants, which she established in 2002. Prior to that, she held a number of roles, I suppose, Chief Financial Officer with HSBC Ireland, being among the most notable, but really fascinating roles right across Europe in the past. And she's also written some pretty impressive books, including the Advanced Taxation book for ACCA. That all sounds very grand, but I can confirm that over the last year or so, I've had the privilege of hearing both of these speak on tax issues, and as a non-accountant have been riveted. So they really have a knack for making the complex understandable and interesting. It's almost a running joke now among some of my colleagues that I'm a wannabe accountant when I start talking about Tom and Paula and the interesting things I've learned from them. So I hope you enjoyed today's session. Please do post your questions in the Q&A box. We might not have a robust Q&A session today, and what we'll most likely do is review the questions and do a follow-up session similar to what we did with Naomi. And again, that's just because of the nature of what we're talking about. It is a rapidly evolving situation, and we know we need to constantly be referring to revenue as they update their FAQs and update what is happening with the wage subsidy and other matters. Okay, so thank you very much. I'm going to hand you over to Tom now. And as I said, if you do have questions, please do communicate with us through the Q&A function. We love to hear from you. Hiya, Tom.
Morning, Ali. And thanks very much for that introduction. It's only when you hear something like that you realize I am such a nerd. So thanks very much for that. I really appreciate it. And it's very kind of you to invite me onto this webinar. I really appreciate it. Welcome to our home. I think it's fair to say that what we've seen in tax terms over the past few weeks is something that we've never seen before. I mean, it's a whole new world. And I know there was a previous webinar, and Paula will spend some time later on in relation to the wage subsidy scheme. So I won't spend long on it other than to say that the speed of making that a reality was just incredible. That law was brought about and was initiated on March 24th. That was a Tuesday. It was signed into law by the president on the Friday, and that law was put together over the previous weekend. Excuse me. That wage subsidy was the 28th section of the law because it had to deal with a whole heap of other law to include issues in the Residential Tenancies Act, time limits in relation to planning and development, regulating health and social care, and then there was tax on top of all of that. So Tuesday to Friday for such complex law is fast. And according to the Revenue Commissioners, and based on data up until the 9th of April, over 41,000 employers registered with the revenue for the wage relief, and over 219,000 employees had received at least one payment, of which about 80% of which had received a top-up payment from their employer. And all of that happened between March 27th and April 9th. And I know there has been more updated information since April 9th, but I really think that that demonstrates that that's fast. And then last week, we saw the minister add to all of that by extending it and by increasing the subsidy in certain instances to 85%, and then going on to cater for people who were paid over 76,000, but are now paid less than that because of the crisis. So I think it's probably fair to say that people have loads of questions on the subsidy, because it's only when you start to get to put it into practice and get into the detail that the difficulties arise. Excuse me a second. I can tell you a story. For example, last week I listened to a 45-minute webinar with the revenue commissioners officials that were responsible for the subsidy. It was 45 minutes and there was 90 questions submitted as part of that webinar. That's an average of 2 questions per 60 seconds of that webinar. And that really put it into perspective for me. And that's why Revenue have been updating their website with their frequently asked questions. And I think they're on version 7 at the minute, and it's being continually updated. So if you're having issues with this, can I apply? Do I have the right type of employee profile? Can I rehire, and so on? Then it's really worth looking at the Revenue's website firstly. And these frequently asked questions are written in what I would call non-legislation, non-techie speak, and non-techie language, so it's really easy to follow. But one thing that came out of that webinar, for me at least, is that Revenue will be prepared to engage with taxpayers who think they might be able to qualify. So it is a case that if in doubt, then engage with the Revenue in relation to the wage subsidy. But one last point on this is what's called the supporting proofs that's required by the employer companies. And that was updated just the other day, the day before yesterday. And among other things, it looks at divisions within companies. You'll recall that there has to be a 25% drop in turnover. And that proof says that the required 25% reduction in turnover or customer orders can be applied at the level of the company, or if a company is formally structured into individual business divisions, then it's at the level of the individual business division. And in that case, each business of the company which has suffered a significant decline in turnover or customers' orders as a result of the virus may be eligible for the subsidy. Of course, there are various T's and C's. So, for example, the decline in turnover or customer orders in each business division must be capable of being separately identified, or otherwise the company has to be looked at as a whole. So no matter what, if you're looking at this whole area, then those documents in the supporting proofs and the frequently asked questions is really required reading. But we move on. And Revenue have said that the charging of interest has been suspended for the March-April VAT return and the April PAYE return. And that's in addition to the earlier announcement that the charging of interest on late payments is suspended for January and February VAT and both February and March PAYE liabilities. And that applies for SMEs. But there's a definition, and the definition that has been applied by Revenue is a business with a turnover of less than 3 million, which is not dealt with by either Revenue's large cases division or the medium enterprises division. Revenue have also confirmed that all audit and other interventions have been suspended for now, as there's a heavy focus on issuing tax refunds. Therefore, this might be an opportunity for taxpayers to consider any open audit interventions that are there, and to talk to Revenue in relation to possibility of arranging a settlement and so on. That's on a case-by-case basis. In addition, current tax clearance certificate status will remain in place for all businesses over the coming months. But what else can companies do to ease their strain on their businesses? And I thought I'd spend a bit of time looking at that and talking about through some of the corporate tax measures that could release cash flow for your businesses. Because I think it's fair to say that the focus so far has been on VAT and PAYE, and there are other things that you can do, particularly in the area of managing payments and losses. and how you can maximize your reliefs. And there are some other cross-border issues as well, which we'll get on to. But on the area of payments and losses, some of this is basic, but just bear with me a second. So if we start with preliminary tax for larger companies, and the criteria for a large company is different from the interest suspensions that I mentioned earlier on, because in tax law, that means companies whose corporation tax liability for the previous accounting period was above 200,000. And any of those companies that have a 31 December year end will be faced with their first preliminary tax payment in June. And in the past, a lot of those companies would have paid their preliminary tax based on the previous year's liability, which they're allowed to do, but they are also allowed the option to base that payment on current year profits. And if the company's current year profits have been reduced, then you may find a cash flow saving by basing your June payment on the projected results for this year. So it's really a case of looking at your estimates and forecasts and to base that payment on this year's situation if that gives you a reduced payment liability. But that's larger companies. Smaller companies will be facing preliminary tax payments later in the year, and they also have the option to base their preliminary tax based on the current year projections and not last year's liability. So that could give rise to an easing of payments that a company thought it might have to make. And if we follow on from that and turn to the whole area of losses, they can give rise to tax refunds. And Revenue have said that one of the things that they are focused on is expediting refunds in the current situation. So if you have refunds due to you, then it's make sure you chase this up with Revenue, because we've seen refunds being released really quickly, and that's really, really good to see. If you're in a situation where you're going to have tax losses for that year, and that's important, tax losses, I'll come back to that, then there should be no corporation tax due. That's step one. But also, you can generally make a payment to throw that loss back to previous years and claim a refund of corporation tax that you paid then. That's step two. So to make that happen, then you might consider filing your tax return earlier to get access to those refunds earlier. But as I said earlier, repeat myself earlier, the key point here is that that means losses in the tax sense as opposed to the accounting sense, in that you have to remember that not all expenses that are included in the profit and loss account are deductible in computing tax losses. So you could have a loss in your financial statements, but still have a taxable profit. And that's something you have to bear in mind. If you're in the unfortunate position of facing a permanent closure of your business, then there is an option under what's known as the terminal loss relief, which allows companies to set back losses for 3 preceding years and receive refunds on that basis. Revenue have emphasized that it's really, really important to keep up your compliance record on tax returns and that you file them on time. You can look at the payments separately, but try your best to get the tax returns in, because Revenue have confirmed that if you're facing challenges, that some of your key employees are sick due to the virus and so on, then you should file using your best estimates. They've said that they won't charge a surcharge if you get the estimates wrong. So for any tax returns that were due and until further notice, put in your best efforts and get them in on time, because there won't be a surcharge if on that basis. Changing tax slightly more to the area of withholding tax. And what that means is withholding tax on payments means that you get less than you billed for because someone else is deducting tax off what you billed for. And that tax is set off against your year-end liability. And there's a thing called Professional Services Withholding Tax, or PSWT. And that's a tax that's deducted from payments by certain state agencies to taxpayers. And right now, the way it works is that you can normally make your claim when your tax return is filed. The ultimate tax liability is reduced or any excess is refunded at that time. That claim doesn't have to be made until 9 months after the year end, and that can be a long time to wait for your cash refund, especially for cash that is withheld in the current accounting period. However, you can apply for an interim refund to the revenue commissioners if you can demonstrate hardship, and typically that will be the case if there was a once-off or unusual reduction in your income, or the withholding tax that you're suffering would far exceed your corporate tax liability. And I think right now, it's fair to say that we are seeing once-off or unusual reductions in income. So if you have a large balance caught up in professional services withholding tax, then maybe think about applying for that interim refund. If we stay in the area of withholding tax just for a second, there's something known as subcontractors tax, aka relevant contract tax, aka RCT. And that was supposed to be, and there was supposed to be an RCT rate review in March of this year, and that's been suspended. And that process would have assessed the current compliance position of each subcontractor on the RCT system and determined their correct RCT reduction rate, be it 0%, 20%, or 35%. And Revenue have said that that process may have resulted in the subcontractor's RCT rate increasing due to changes in their compliance position. And for that reason, the review was suspended. However, they also wanted to remind subcontractors that RCT rate reviews can be self-managed on the Revenue Online System, or ROS. And subcontractors can check if their rate should be lower, and they can self-review to get the lower deduction rate. And finally, on this area of payments, if you're still having tax payment difficulties, then Revenue have pointed, as part of their guidance on the virus on their website, to their phased payment arrangement system. And entering into a payment arrangement with the Revenue Commissioners means delaying your payments. And for those of you who are interested in this area, there is quite a detailed revenue guidance on it on their website, and it was published earlier in this year, critically pre-virus, which sets out the various terms and conditions. Revenue have emphasized that it's not unusual to them. They are used to dealing with businesses on phased payments. And I think the point that Revenue have emphasized recently is for early, positive, and honest engagement with them, with the taxpayer. Get in touch with them. You can do it by phone, online, and so on. What this can do is it brings about a lot of flexibility, and you can manage your payment schedule, and often you can defer payment. So it's a good move that way. However, under the current guidelines, you have to make a minimum payment of 25% down payment, or 40% if you're also looking for tax clearance. Also, interest will still apply under the current guidelines. So the interest suspension that we talked about earlier and that has been announced only relates to VAT and PAYE for the SMEs as defined, as we spoke about earlier on. They haven't gone as far as yet as other taxes, so that's just something to bear in mind. And now for something completely different. For those of you who are engaged in research and development, you'll be aware that there's a credit available for certain expenditure, provided it meets all the various T's and C's. And the key thing, and I've always said this, that the R&D credit isn't all about rocket science, computer science, chemistry professors. It's about ordinary people doing extraordinary things in their own field. And the way it works is it gives a tax credit of 25% of the expenditure, qualifying expenditure. But it's likely that that expenditure would already have been deductible by a trading company. So that means that the company's tax liability has already been reduced by 12.5% of the expenditure. So the credit brings the total benefit up to 37.5%. So it's very valuable. And one of the largest incentives that we have in this country, and something that you should seek to maximize if you can at all possible. On top of that, the law provides that excess R&D credits can be paid in cash to the company concerned in 3 installments. And Revenue have said that an exceptional installment as a result of COVID-19, and of course subject to certain checks and balances in selected cases, Revenue will expedite the payment of any instalment of excess R&D tax credit that is due to be paid this year, bringing forward payment in advance of the date that's actually provided by the law. They've said that to enable the payment of the excess credits to form the tax return for the company's accounting period ending in 2019 must, at the time of the request for the refund, be submitted. Those of you that have intellectual property companies or IP companies, and particularly those of you who are Irish headquartered, where you're developing IP or engaging in R&D, then there is another form of relief which potentially allows you to halve your corporate tax bill to 6.25%. And the relief is known as the knowledge development box. So that's a really valuable measure, and it can halve your tax bill. So something that's definitely worth looking at, particularly if you're Irish headquartered. Another way of reducing your corporation tax is through capital allowances, or what's sometimes referred to as tax depreciation. It's not unusual to find in building and construction work that there is qualifying plant in the building, but often that gets accounted for and booked as part of the cost of the buildings in your financial statements. And unless that building meets the legislative definition of an industrial building, and there are various terms and conditions, then it won't be available to claim tax depreciation. However, what we found is that if you have a new building, then often between 5 and 40% of that building could qualify potentially for plant and machinery capital allowances. If you have a fit out, that could go up sometimes as high as 70%. It's very much back to specifics. But this can come down to stuff like air conditioning, alarms, lifts that can qualify for plant and machinery. And that could mean that you could get tax depreciation you didn't think you were entitled to because you thought it was building and not plant. In general, that means that the qualifying plant can be written off over 8 years for tax purposes. Finally, because I'm conscious that I've taken up a lot of your time on my slot, many businesses have international operations. And Irish Revenue have confirmed that if a foreign operation has people in Ireland and they're unable to get back home because of the virus, then they would not be regarded as a taxable presence here. But of course, that gives rise to the question that if you have people abroad that can't get back home to Ireland, then could they constitute a taxable presence abroad such that foreign tax will be attributable there as a result? And that's a country by country question, but the OECD has recommended that countries follow the Irish response. Similarly, a company in certain conditions can be regarded as managed as being what's known as tax resident for tax purposes, where it is managed and controlled. And that generally means that it will be taxable in the country of management and control. So how do you maintain the tax residency of an Irish company if some of the directors who come here and who sit on the board and are on the board just can't get here? And Revenue have issued the guidance and said, and this is all from memory, so bear with me, if an individual is present in another country because of the virus and would otherwise have been present here, then Revenue will be prepared to disregard the presence abroad for corporate tax purposes for a company in which the individual is an employee, director, and so on. And critically, they've said they'll apply it the other way around, which is a good move. And it shouldn't give rise to potential moving of a company's tax residence on that basis and as a result of their virus. Of course, as before, there are two sides to this, and other countries have to be looked at. In other words, that's a country by country question, but the OECD has recommended that they follow the Irish approach and the Irish response. I think the key takeaway from my side, at least, is that there are a number of things that taxpayer companies can do to reduce the tax strain as we go through what I've been calling in my column the Jurassic economy. And there are various reliefs and refunds available, and it's just a matter of engaging with Revenue if you think you may be eligible for reliefs. And I know Paula will go into some of these and more even in a bit more detail. So that's me. once again, thanks very much for your time and for the invite to participate in this. It's really much appreciated. Eilish, Paula, back to you.
By that, and I counted here 10 pieces of information in ways to potentially reduce tax, and fantastic. And Tom is, as Eilish said earlier, is really the guru. He's a very modest man, but you are the guru, and you do write the tax Bibles, Tom. And this is not
so
a coincidence. You'll note just here where my pen is that that's Tom's CGT book, and I tell you, I do look at it quite a bit. It's very accessible. So really good advice there, Tom. Just before you head off, I was just going to ask you, Tom, I don't know if you watched Prime Time recently. Stephen Kinsella was on it, and he recommended a commission on taxation, and I thought that is not a million miles away from what you've been talking about on your column. You know, you've mentioned a deep dive into tax on your business post column. I'm just wondering, could you elaborate on that and give me your views? What you think?
Sure, of course. And like, I was really delighted that Stephen raised it on Prime Time. And basically, what the Commission on Taxation. You remember that the last financial crisis, within a year of that, there was a group brought together to form the Commission on Taxation, and that group comprised tax advisors, lawyers, NGOs, trade unions, academics, economists, the lot. And basically, the idea behind it was to bring them all into one room and get them to do a deep dive into tax law as to how it could be improved and how it could be looked at. Now, and Stephen made the same point that I did in my column, that deep dive back then took about a year and a bit. And I think Stephen called it a need for a rapid Commission on Taxation. And I called it, Scott, the Strategic Commission on Timely Taxation. So his was more eloquent than mine. But I think the idea is to get that group of people into a virtual war room, as I call it, and basically look at what tax can do right now. Leave the deep dive in relation to the law, and I think it would be good to do that deep dive, but leave the deep dive for a little while, but look at what tax can do right now in relation to the situation that we're in right now. And the only addition that I'd make to it is that to the previous Commission on Taxation is that, as well as having all those people and those experts in the room, is to have revenue legislation drafters in the room. So in accordance with decisions were being made, that legislation gets drafted there and then, ready to fit into a national development plan. And that's Stephen didn't put it that way, and but I think both of us are of the same mind in relation to the Commission on Taxation. So I was really thrilled when he said it on
Friday. How likely do you think that is, Tom, to happen? What do you think?
Well, I would hope that it would happen. We did it the last time in relation to the last financial crisis. So we've done the deep dive a while back. So now let's just focus. If we just focus on all of those groups, the constituent groups, that I mentioned, their needs. As I said in the column, nobody should get left behind. Everybody's needs to be catered for as much as possible. So it would be great if it could happen.
Okay, well, hopefully. Well, Tom, thank you so much. That was excellent. Really, very, very useful. Thank you so much.
Not at all.
Okay.
I'll leave you with the guru and in Paula, and sure we can talk to you.
Go way out of that. Go on.
Thanks very much for your time.
Okay. Thank you, Tom.
Bye-bye.
Okay. So let me share my screen with you here, guys. Okay. So you should all be able to see my screen here, which is my PowerPoint slides. All right. So just give me a moment here because I like to see. Okay. All right. So a big thanks to Tom. It was great, and that's who I am. Eilish gave me a very nice introduction at the beginning, and delighted to hear that Eilish is riveted by taxation. Hilarious, but No, she is actually. I find her or a non-accountant. She's not half bad. She understands what we're talking about, which is brilliant. She's a lovely person to work for, by the way. Okay, so COVID-19, right, where are we now? We are firefighting. We're kind of coming to the end of the firefighting. I think we're thinking that, you know, it's kind of business as usual now. And this is our new normal. But also, I think now gives us a chance to strategize and to think about the future. Now, I know any of us who are still working, you know, and are working at home, I think we're working harder than ever. So maybe you don't have the time to think, but those of you who, you know, you're not working, you know, use the time to have a little think about things. So I'm going to talk about the COVID-19 tax supports that have been introduced, and then I'm going to get on to what I consider the more interesting bits, all right, going forward, all right, because it was already, it was so interesting what Tom said there, actually really puts it into perspective, doesn't it? That it was introduced on a Tuesday and it was signed off by Michael D. Higgins on the Friday. I mean, it's mad stuff. So so that's the wage subsidy scheme, of course, I'm talking about. So I know there's issues with it, but and then already it's been, they're talking about now tapering off these tax supports. But anyway, this is where it is as at today, which is the 23rd of April. Okay, so tax returns. So businesses experiencing temporary cash flow difficulties, you should continue to send in your tax returns on time, or even earlier, as Tom said there, if you want to try and avail of some tax relief on losses. Application of interest, that's been suspended for PAYE and VAT. They are prioritising VAT refunds. In fact, they're prioritising a lot of all the refunds. Debt enforcement. So all debt enforcement activity is suspended until further notice. So thank God you won't have the sheriff arriving at your door. Are the nasty, horrible letters that you get from revenue. Tax clearance. So current tax clearance status will remain in place for all businesses over the coming month. Now, wasn't it very interesting what Tom said there about phase payments? So if you don't have a current tax clearance certificate, engage with revenue, and I definitely would support him on that, absolutely. They're terrible, nice people to work with. I do mean that. So the minimum for phase payments is you have to pay a minimum upfront of 25%. But if you pay 40%, that gets you your tax clearance certificate if you don't already have it. All right. So, and as you know, you need tax clearance certificate to work with certain people. And so 40% will get you that. Your surcharge for late corporation tax returns is suspended. The RCT rate review is suspended. A deferral of commercial rates in only some sectors. And then we have the gorgeous wage subsidy support scheme. Alrighty, so let's talk about where we are with that. Now, what is that? I'm sure you all know what that is. So the government is asking employers who have closed their business to continue to pay workers if possible, to keep everybody off the live register so that they're ready to go back to business when all this is over. So they announced a new income support scheme to assist employers with paying workers during the pandemic. And this scheme is administered through revenue. And I guess that's why we're kind of outside of our comfort zone, because this is a welfare support, but it just so happens the revenue are administering it. Okay, so there is, and I'm sure I should put that up later on. It's the link to revenue, and as Tom mentioned, he said that Q&A is a very, very good area in revenue, and that would be your first point of contact. Okay, so what are the changes? So these are the changes that are going to come into effect on the 4th of May. So on the 15th of April, changes to the wage subsidy scheme were announced. And these take effect from the 4th of May, and they won't be backdated. And basically, what are the changes? They're going to look after the lower paid and the higher paid and introduce a bit of an L-tiered system. Alrighty. Okay, so what is that? So the subsidy will increase from 70% to 85% for employees with a previous average take-home pay below €412. So in other words, if your previous gross salary was less than 24,400, the subsidy that the state is making available increases from 70% to 85% to bring them up to the 350, because a lot of them weren't reaching the 350 and they would have been better on the pandemic unemployment scheme. So they've just corrected that little anomaly there. The subsidy will be €350 per week for employees with a previous average take-home pay between 412 and €500 per week. So if your previous gross annual salary was between 24,400 and 31,000, you're entitled to a flat rate of €350. Now, the subsidy remains the same for employees with a previous average take-home pay of between 500 and €586 per week. So in other words, if the previous gross salary is between 31,000 and 38,000, the subsidy is capped at 70% of the previous take-home pay, up to a maximum of €410 a week. Now, a tiered system, this is a new thing that's been introduced for employees with a previous average take-home pay of over €586 a week. So if you have a gross salary of 38,000 or above, this applies. So for workers receiving up to 60% of normal pay from an employer, the subsidy is up to €350 a week. And for workers receiving between 60 and 80% of their normal pay, the subsidy is €205 a week. And if you're receiving more than 80% of your pay, you don't get anything. Okay, now high earners. So the high earners, they're people who are previously taking home more than €960 a week. So this is their take home. That equals roughly about 76,000 gross or more per annum. And I know this has been very, very welcome. So there's a tiered arrangement that also applies, which I've just mentioned. So it's the exact same rules, right? And that's that is not backdated. So it applies from the 4th of May and it is not backdated. So we're looking after the lower earners, the higher earners. The higher earners didn't get anything. So I think this is very, very welcome for them. And there's a tiered system. Alrighty. Okay, now to qualify for this scheme, you have to self-declare to revenue that you have experienced significant negative economic disruption with a minimum of 25% decline in turnover in the second quarter. Now, believe it or not, revenue have a presumption of honesty on your part. Right, so they think, oh yeah, so the reality of it is they're not asking you to submit proof, all right, but you do keep the proof in case you're ever asked for it. Okay, so, and if you have strong cash reserves, you still qualify for this. And I know initially, I know a lot of my clients, you know, that was an area of doubt where they would have strong cash reserves and they didn't think that they qualify, but they absolutely do qualify for that. Now, I thought it was interesting what Tom said there. He said that he was listening to a Q&A there and he's more up to date than I am on this. And he said that at a company level, it's not just at a company level that it's 25% decline is looked at. If you have a company that has various different sections and various different departments, so it doesn't have to be at a company-wide level that the 25% decline in, say in department 1, say that declined by 25%, well then that department can claim for the wage subsidy. Alrighty, so that was very interesting. Now, the strong cash reserves still qualify. Now, also, you must be unable, and the proof, so what proof are you going to keep actually? Let's think about this. So the proof that I would keep is look at your management accounts from quarter 1 compared to quarter 2. If you can clearly demonstrate that sales have diminished, that's fine. Or you could look at quarter 2 this year. You could look at your orders as well. So it doesn't have to be sales, it doesn't have to be income, it could be a number of sales orders. So that's an interesting one. And we all are definitely, I mean, people are down 25% at least. Now, you also must be unable to pay normal wages and normal outgoings fully. So you're probably going to say, but what about those strong cash reserves I have? So if you have strong cash reserves, well then, okay, so the idea is here, what I'd recommend is keep documentation that your strong cash reserves or any cash reserves you have are being used to meet your debts. And that'll get you over that hump. Now, you have to keep your employees on your payroll, and your employees must have been on your payroll on the 29th of February 2020, and you must have made payroll submission on their behalf to revenue in the period from the 1st of February 2020 to the 15th of March 2020. Now, your declaration is not a declaration of insolvency. So I know there was some worry, and a lot of worry about that initially, and that brings into question auditing and all this rest of it. Don't worry about that. It's simply a declaration that the COVID-19 pandemic has caused disruption to your business, alrighty? Okay. So employers must not operate this scheme for employees who are also making a claim for the pandemic unemployment payment. All right, so if they're drawing social from, that makes sense, doesn't it? So you can't have both. Now, the COVID-19 wage subsidy scheme applies both to employers that top up their employees' wages and those that are not in a position to do so. But if you are topping up your employees' wages, the top up bit, so let's say they're getting 70% and you're topping up by anything another 30%, that extra 30% is tax deductible for you. I know there was some confusion around that earlier on, so just to clarify that 30% is tax deductible for you. Obviously, the 70% of the government are paying or revenue are paying is not tax deductible. And I think that makes sense as well. All right, now Naomi Butler on the very, very first one of these podcasts gave an excellent presentation on the wage subsidy scheme. So, if you, and it would be, I know some areas have changed, but it might be well worth another look at, or if you wanted to have a look on revenues, questions and answers. Now, what to look out for here now is look out for pension. So, now I've lost my train of thought, what I was going to say there. I'll come back to that. And watch out for your losses. It'll come back to me. So your losses. Now, it depends, as Tom said, if you are a sole trader or a limited company. So if you are a sole trader, you could have losses, and if you're a limited company, you can also have losses. So let me just talk about the differences in the losses and how you can claim back those losses. So it is a reality, that we may incur losses. So if you have I love a sole trader that makes a loss, alrighty? It's because if you make a loss this year, that loss can be offset against all of your other income for this year. So even employment income, maybe you have a rental property down in Cork and you have rental profit from that. Your loss that you make as a sole trader can be offset against all of that other income. So I think that's very exciting. And any unutilized loss can be carried forward, but only against future trade profit. So you can offset it. It's a very lucrative loss. It's very useful. And you can offset it against your spouse's income also. So bear that in mind. And anything you can't utilize this year, so there's only the year of the loss that you get to offset it against all your other income. And anything you can't utilize, carry it forward until you can, but only against future profits from your trade. So it's only in the year of loss that you get to use it against all your other sources of income. Now, it can only be carried forward, not back. That's the thing. Unless it's unfortunately a terminal loss where you're deciding that you're going to close up shop, as Tom mentioned, then it can be carried back 3 years prior to the year of loss. That's the only time that a sole trader loss can be carried back. Now, what does that mean in reality? That means that you get a refund of taxes that you paid in previous years. Happy days. Okay, so that's a sole trader. And then we have corporation tax losses. And I hope I'm not going to insult anybody here, but people come to me and they'll say, am I a sole trader? So a sole trader is anybody who is self-employed. That's what it is. If you're out cleaning windows, you're a sole trader. If you're an electrician, you're a sole trader. If you're a farmer, in all likelihood, you're going to be a sole trader. Right, so if you set up business, in all likelihood, you would have set up as a sole trader if you're a small to medium-sized enterprise. Okay, now corporation tax is when you become a limited company. So they're slightly different. Now, that's ring-fenced within the company. So you can only, the losses are only available to the limited company. So they can't be offset against your employment income or your wife's or your husband's income, all right? So it's only the limited company that can use the losses. Now, they can be carried back. Isn't that interesting? So income tax losses can't, but corporation tax losses can be carried back 12 months against trade income, and then against other company income from the loss-making year, and then carried back 12 months against other income, and then any unutilized loss carried forward. And I've probably totally lost you there. So let me just put it to you another way. So let's say you've got a company, and let's say you're a plumber. All right, so your plumber is your trade income, and that's up here. And let's say your company also owns maybe a rental property. So the company has two sources of income. You've got what did I say he was? He's a plumber. You've got a plumber and you've got some rental income, all right? Now, but however, and you'd have that going along all the years. But unfortunately, you've made a loss this year in your plumbing income. So what you can do is you can bring that back 1 year, bring it back to offset it against the trade income from your plumbing business last year. All right. And then if you've any loss left over, you'll offset it against this year's rental income. And if you've anything left, you'll set it off against last year's rental income. And then if you've anything left, you'll carry it forward to be offset against future trade income, future plumbing income, if you like, right? So there's an order of set off there, right? But the highlight is you can offset it against last year and then carry it forward. Terminal losses, again, if you're in the unfortunate situation, same rule applies, that you can carry the losses back against trade income only for 3 years preceding the year of the loss. Okay, so I know I'm being very clinical in talking about losses, and you have got a loss, it isn't, so apologies if you think I am being very clinical about it. So I am just thinking, tax-wise, and I do sympathize with anybody who is making losses. I just want to make that point. But I just want to let you know it's not the end of the world if you do, because it can result in tax refunds from previous years, alrighty? Okay, so if you are considering whether to top up your wages of your staff, remember that by topping them up might help you actually generate a loss, all right? So if you're just borderline at the moment, that could put you into a loss-making situation. Okay, so going forward, we've time to think, right? And hopefully I'll have time to think about what my point was earlier on the pension. And I've remembered what it is. Okay, so what it is, and I do talk about pension later on because it's very important, and I do like pensions, they're very tax efficient, is that if you're working somewhere and you're being paid the wage subsidy, that qualifies for net relevant earnings for your pension investment. So we look at this later on, if you are a sole trader or if you are an employee who is contributing towards a pension scheme, your tax relief is restricted by an age-related percentage of something called net relevant earnings. And just to make the point that if you are being paid this wage subsidy, that counts as net relevant earnings. All right. Now, so going forward, I thought it'd be quite nice if I could impart some free tax advice to you guys. And I sat down, I thought, well, what are the 4 top questions that I'm asked? And my questions that I'm asked, I'm always asked a lot of questions, and people will start by saying, Paula, I have a quick question for you. And they're never quick. They're quick to ask, but they're not quick to answer. All right, so these are my 4 most asked questions. And they are, should I register for VAT? Should I incorporate? And if I have incorporated, how am I going to get cash out of the company? And how do I plan for succession? In other words, how do I pass it on to the next generation, right? And what I didn't want to put in writing is that another question I always get asked is, can I claim this or can I claim that? And the most unusual requests I've had over the years is, can I claim Botox? Where if you're on TV and everybody has Botox, can they claim it? And the answer is, you can't. Sorry about that. And the other question I get, I had a very unusual question when somebody asked me, could they claim their manicure? And I said, I can't remember what business they were in. They weren't in the beauty business. They were a consultant of some sort, a business consultant. And the question was, right, and I said, why would you claim that? And they said, because I go like this to my clients. I go, and there you go. I thought that was absolutely hilarious. Okay, so I'm getting flashes here for, I'm just looking to see, do I have any questions?
I'd imagine, Paula, there's going to be plenty of questions coming in once you start going through these questions here.
Yeah, okay, perfect.
So it's really, really interesting, and yeah. Definitely.
I'll be asking you questions later now, Eilish.
I'm ready for my pop quiz.
Okay, all right. Okay, so let's go ahead with this. Okay, so should I register for VAT? Now, so this is if you are providing a vatable good or service. So it doesn't apply if you are in an exempt business. So it's easier for me to tell you what an exempt business is. Well, the top ones would be anything medical. So when you go to your doctor, he doesn't charge you VAT, does he? So he cannot register for VAT. Then there's education. If you're in the business of education, that's an exempt business and you cannot register for VAT. And insurance would be another one. So when you pay for the insurance on your car, you're not charged VAT. So this is only applicable to anybody who is providing a vatable good or service. All right. Now, of course, you have to register if your turnover is above a certain limit. Compulsory registration. So if in any of the following thresholds exceed or is likely to exceed in a 12-month period turnover of, so if it is sale of goods, it's 75,000, and if it's the supply of services, it's 37,500. All right. Now it's likely, if it's likely. So let's say you set up business today and you think, well, I'm likely to exceed 75,000. Well, then you have to register for VAT. Right. So remember, sale of goods is 75,000 and supply of services is 37,500. All right. So that is a no-brainer. You have to register. But then you've got the situation where some people will voluntarily register for VAT early before they reach the threshold. And why is that? Okay, so you can you can make the election to register for VAT. And now remember, it's only somebody who's in the business of providing vatable goods and services. So no doctors, no educationalists or or insurance companies. Now they might want to register if maybe they haven't started trading yet, but they're incurring large vatable pre-trading expenses that they'd like to claim an input credit on. So let's say I'm thinking of setting up a business that I'm going to be selling markers. Alrighty, but to do that, I need to buy a big machine, and the machine is going to cost me a fortune, and I want to buy that like sooner rather than later. And I'm not ready to actually set up business probably for another few months. Absolutely, you can register early and claim the VAT back on your input VAT on whatever you purchase. Or maybe they've started trading, so maybe you're already trading and you haven't reached your registration limit, but you want to be able to claim back your VAT on your purchases. All right, it depends on what type of business you're in. Right, so me as an accountant, I don't have a lot of stuff that I would buy in. I have my photocopier years, I've got my computer equipment years, so I don't really incur a lot of VAT. So it depends on the type of business that you're in. So if you're manufacturing something, you would incur more than I would. Or maybe you deal in zero-rated goods. Now that's an interesting one. So what are zero rated? So you know that we have different rates of tax, VAT. You've got your 23% and your 13.5% and your 9% and it goes on and on and on. And then we've got your 0% at the end. So 0% would be essentials, and bread would be considered bakery goods. Bread is considered an essential item in Ireland. We love our bread. So if I'm in the business of selling bread, I don't charge VAT. I charge VAT at 0%. Okay, then I do my tax return to revenue. And I'm a tax collection agent, if you will. So I'll say to revenue, okay, here's my tax return. So I charge 0%, but look, I can claim back all of these tax deductible expenses. So that's when it is, you always will be in a repayment situation with, if you're zero rated. So absolutely, don't wait till you get to the registration limit, register away. I've got some scenarios here. So this is Paddy Maloney, and Paddy Maloney is a business consultant, and he set up business 6 months ago. So he's only a newbie and he's not VAT registered. Now, Paddy intends to purchase some expensive office equipment in the near future. And Mary McGee, she's also a business consultant, and she's also recently established, and she wants to buy a fancy photocopier or printer in the near future. So both of them have some purchases to make. They both charge a similar price and they offer a similar standard of service. Okay, but now should they, that's my question, should they voluntarily register for VAT? Now, because if they do, they can claim back the VAT on their intended purchases. However, they're also going to have to charge VAT to their customers. Now, so Paddy's in red there, Paddy's main customers are medical consultants, right? And as medical consultants, they're VAT exempt. They don't register for VAT. They cannot claim back the VAT. They have to suffer that as an expense. So will Paddy, if Paddy registers for VAT, yes, he can claim back the VAT on his expensive office equipment, but then he'll have to charge VAT to the medical consultants, putting up his fee by 23%. So not too sure how happy they'd be about that. Now, Mary, her main customers are IT companies, so Apple and Google and the like. So they are going to be VAT registered. So if Mary registers for VAT early, she'll be able to claim back all of her VAT inputs on her photocopier and all the rest of it. She'll have to charge VAT to the IT companies. Will they care? They won't give a damn, because when they do their own VAT return, they'll claim that back as a VAT deductible expense. So it depends on who your customers are. So Mary supplies services to VAT registered people. So it's irrelevant to her customer if she is VAT registered or not, as the customer can claim back the VAT and Mary can claim input tax credit on her purchase. Alrighty, so I hope that's clear. And if anybody has any questions on that, they can ask me at the end. Okay. So question number 2 that I asked a lot is, should I incorporate? Now, what does incorporate mean? Incorporate means, should I become a limited company? That's what it means. All right. So income tax is high. It can be as high as 52% if you take into account your universal social charge that you don't get any tax credits on, and your PRSI. Very expensive. So this would be a question people would say, oh, I was talking to my friend who did a course in accounting and they say I should be a limited company. Why am I not a limited company? And corporation tax is 12.5%. Now it's 25% on some sources of income, like just to mention that. So earlier on, when I said about the plumber who had some rental income in the company would actually pay 25% corporation tax on that rental income, right? But for the main, on trade income, it's 12.5%. Okay, so let me give you a scenario. So you've got a sole trader, a plumber again, and he's making profits of 100,000 a year. Nice. Profits, taxable profits. And let's say I'm the plumber and I have rental income. So my cut off and tax credits are all utilized. So what I'm trying to do there is to keep it very simple. So I'm trying to say is that I'm a plumber and it's not my only source of income. I have other sources of income. So my tax credits, which would be my, you know, my earned tax credit and whatever else, single person tax credit or married person's tax credit, they've all been eaten up by my rental income. And my standard cut-off, which is in plain English means what I pay tax at, 20%, that's all been eaten up, right? So I'm paying tax at the 52%, to keep it nice and simple. 52,000 euro. 52,000 euro. I mean, it's mad. Okay. So, and I decide to incorporate. I don't go and see anybody for advice. I listen to my friend and I say, yeah, I'm going to incorporate. So let's consider two scenarios. Now, the first one is a little bit tongue in cheek. So scenario one is I like my handbags, my holidays, etc. And scenario two is I'm more frugal. So scenario one means that I need all of the 100,000. I'm going to spend it all. And scenario two is I'm frugal and actually I am going to be really, really careful with my money. So let's say that with profits of 100,000, I decide to incorporate. Okay, so here we have, so I've kept you away from the figures for as long as I can. So here we have some figures. So scenario one and scenario two. So scenario one, we have a limited company. So remember now, this is Paula Byrne Limited. I'm Paula Byrne Plumbing Limited. And I've got scenario one, scenario two, the exact same. But in scenario one, I need all that 100,000 to fund my exorbitant lifestyle. And in scenario two, I take out 25,000. That's my salary. Okay, and my salary is tax deductible. Okay, so I'm probably a shareholder director now in this company. So if I have taken all of the salary out in scenario one, what I have left that I have to pay corporation tax on is zero. And scenario two, it's 75,000. Now this slide is repeated here. It's at the top here. Now, so in scenario one, I'm going to work out what my corporation tax is. So all I do is I say, right, well, in scenario one, by the time I took out the expense of my salary, I've nothing left to be taxed. So corporation tax of 12.5% of nothing is nothing. However, that 100,000 that I took out of the company, probably by way of a salary, I have to pay tax at 52%. So that's my 52,000. So do you see there, scenario one is the exact same as when I was a sole trader. So when I was a sole trader, I paid tax at 52,000. And here I am, because I'm taking everything out of the company, I have to pay income tax at the exact same rate. And for simplicity purposes, we're just saying it's 52%. And there we have, so this is a ridiculous situation because I've gone to the expense of incorporating, my accountancy fees are better. I've got the stress of making sure I'm filing everything on time with the CRO. Okay, now in scenario two, I have 75,000 that's accessible to corporation tax. So at 12.5% of that is 9,375. That's my corporation tax. And now I'm only taking out 25,000 at 52% income tax. So my income tax on my salary is 13,000. My corporation tax on my corporate profits is 9,375. So my tax overall is 22,375. Right, so what does all that mean? That means that don't go incorporating if you have to rip everything out of the company, because then you're just back to being paying tax on income tax on whatever you're ripping out of the company. But scenario two hopefully highlights to you that if you can afford to leave profits in the company to be taxed at the lower corporation tax rate, well, then it is worth your while. So if you're just setting up now and you're just about getting by, it probably isn't worth your while incorporating. Wait and review it probably every 12 months with your accountant. All right, so in other words, the less I extract, which is probably a more professional way from saying rip out, so the less I extract from the company, the less overall tax is paid. If I need to withdraw a large amount to fund my lifestyle or indeed debt, then it's not worth it. It totally is not worth it. Okay. So the higher the profits that you're making, the more favorable it is to incorporate. If you're just about getting by, stay as a sole trader, it's not worth it. Right. Now, pension. I promised we're going to talk about pension, and here we are. So, pension. What's the story with the old pension? So there are, as you know, we have the state pension. Then there's something called personal pension. And then we have an occupational pension scheme. So there's 3 types of pensions. So the state pension, well, you know, that the age has been pushed out for that, you know, and by the time she's very young, retires, she'll probably have to be 80 before she accesses the state pension, all right? Now, the personal pension scheme is when you are a sole trader. You pay into a pension scheme if you want. And it also applies to an employee who invests into their own pension. And then you have a gorgeous occupational pension scheme. And that is when a company that you work for, so if you are a limited company and you've incorporated, you will be working for that company and they set up a pension scheme and pay on your behalf. So what I'm interested here is the sole is a pension, and I'm going to examine from both a sole trader perspective and from an employee perspective. And when I say employee, remember, this includes directors, right, of the company. Okay, so they're treated very, very differently for tax purposes. So the pension investment for a sole trader, what element of the pension is tax deductible? So I'm a sole trader, okay? Paula Byrne Accountants, I'm a sole trader. So I will save income tax based on an age-related percentage of this net relevant earning things that I mentioned earlier. And the maximum that the net relevant earnings can be is 115,000. And that's really important, all right? So I think a lot of you are sole traders. So let me just explain that again. So it's based, so first of all, it only relieves income tax. It doesn't relieve universal social charge. Now, universal social charge is a killer. So it doesn't relieve that, and it doesn't relieve the PRSI, only income tax. So if you pay income tax at 40%, it's very, very tax efficient to do this, nevertheless. Now, it's based, so you get a tax break based on your age. Now, for my age, it's either 20%, 25% or 30%. I have it on the next slide, actually, so you will have a look then. And that's the percentage of your net relevant earnings. Now, what does net relevant earnings mean? It just means what is your earned income. So it's something you've actually got up and you've gone out and done. So it doesn't apply to rental income or what we consider passive income. It doesn't apply to interest income. It doesn't apply to dividend income. So your net relevant earnings is your employment income or your trade income. However, let's say that as a sole trader, I'm making, let's say, 150,000 a year profit tax. I won't get my age-related percentage of the 150,000. It is restricted to 115,000. So that's not good. So there's a lot of restrictions here, isn't there? First of all, so I can't just say, okay, I've got 50 grand, I'm going to invest it into a pension and I'm going to get me 40% tax break. That's not how it works. It depends on what percentage according to my age and depends on my net relevant earnings. Too many restrictions there. Now, what about if an employer, so let's say Paula Byrne Limited, pays on behalf of Paula Byrne? Well, there isn't the same limit. they can pump it in, and the company will get tax relief. So the company is making the investment into the pension scheme, or the contributions into the pension scheme, and they get tax relief at the corporation tax rate of 12.5%. Now, the best thing about this, which is fabulous, that it isn't a benefit in kind for me. So if I'm working for the company and the company is paying into a pension on my behalf, I don't get taxed on that. Okay, so you'll probably say, but you don't get to see it in your monthly pay slip. Yeah, but I'll see it when I'm retired. It's fantastic. Okay, now here's those age-related percentages I was telling you about. So I'm in the 30% bracket there. So the older you are, the higher the percentage that you get. Now, what about if you decide that you invest more than you get the tax relief on? That's all right. You can carry it forward to next year and you'll get the tax break on your over-invested pension next year. So that age-related thing is just to do if you're a sole trader, or indeed if you are an employee making contributions, your own contributions. Alrighty. Now, what happens when you retire? So which one do you prefer there? So it's better to be an employee of a company. Now, but only if you have plenty of money. So maybe if you're a sole trader, you can't afford to be putting anything into a pension, or very little. And if that's the case, well, then stay as a sole trader. So do you see, it is probably more tax efficient to incorporate only if you are making lots of money that you can afford to leave in the company to be taxed at lower rates, and if you can afford to pump loads of money into a pension scheme to get the ultimate tax break on that. Anyway, on retirement, what happens? So your personal pension, and then what happens to the personal pension? Okay, so you can take 25% of the fund, up to 200,000 can be taken tax-free. Very nice indeed. If it's an occupational pension, which is the one now you're working for the company, up to 1.5 times your final salary, again, up to 200,000 can be taken tax-free. Now, it's easier to get to up to the 200,000 in an occupational pension scheme. So the occupational pension scheme potentially gives you access to a bigger tax-free lump sum. So if you've done up to 20 years in a company, you get 1.5 times your final salary, tax-free. So you're not restricted by that 25% of the fund business that the personal pension people are. So you potentially have access to a bigger lump sum. It's based on the number of years you've worked for the company. It's not based on the number of years you've been in the pension scheme. So if you're working somewhere and you could be working there for 10, 15 years, go into the pension scheme on one day and then you retire. You are still, this is still applicable. You can get 1.5 times your final salary. Now, I worked somewhere, and I can't mention where it was, but it wasn't where Eilish said that I worked, it was somewhere else. And I noticed that in the last, and I was very young, but I noticed that one of the older guys was retiring, and I noticed in the payroll that he got a big salary increase in the year that he was leaving. I thought, that's very odd. Why is that? Oh, God, very good. And then, so he left, and then the next person coming up for retirement, again, he got a big salary increase in his final year. So later on, when I started studying tax, I realized, well, this is why that was happening, all right? So without going into it in too much detail. Okay, so should I incorporate? So there's a bit of tax planning you could do there. Only if you're making sufficient profits that you can leave profits in the company, that you don't have to rip them out for the handbags and the holidays or whatever else, or indeed repaying your debt. And or you're making sufficient profits that you can invest a significant amount into a pension. Alrighty? When I say you, I mean the company. But you can contribute as well. But now you have to bear in mind the close company rules, and I didn't want to bore you with science here, but what is a close company? A close company is a company that's under the control of 5 or fewer participators, so they're mainly shareholders. So most companies, you know, are close companies, and there is a funny rule that if you are a limited company and if you have some undistributed estate or investment income, you're penalized. What does that mean? It means that you're discouraged from companies holding investment properties on their books. You'll be penalized if you don't offload all of it or distribute it all out to the shareholders. But what's more relevant to you guys is if you are a service company. So if you are what we call a Schedule D2 company. So in other words, if you are a consultant or an accountant, that you are penalized somewhat from incorporating. You're penalized insofar as if you don't take out all of the profits from the company, they'll penalize you with what's called a service company surcharge. So, and that is, you take your profits, you tax them, and then you halve them, and then the surcharge is 15%. All right. Okay, so I hope I haven't frightened you too much, but just bear that in mind that there is a close company surcharge that kind of, it makes it a little bit unfavorable for service companies to incorporate. And what's involved in incorporation? Well, and Eilish will share this with you later. So very nice steps there on the CRO website, and it tells you all the steps that you need to take. All right. Now, what are the tax consequences? So how do you actually incorporate? So let's say that you are a sole trader, and okay, so you've decided, look, I've listened to Paula's webcast and I think, you know, my profits are huge, hopefully going forward, maybe next year, and you decide I am going to incorporate. Right, well, that's not without its tax consequences. So if you incorporate, what you're doing is, but there is scope here now for making a fortune. All right, so listen up. So if you incorporate, what you have, you're actually offloading your assets from your sole trader business to your limited company. And because you're offloading your assets, you are subject to a tax called capital gains tax. Now, capital gains tax is either 33%, mainly 33%, or 10% if you qualify for something called entrepreneur relief. Entrepreneur relief is available in some instances in incorporation, right? Or else you mightn't have to pay tax just yet if you qualify for something called incorporation relief. So with a bit of fancy planning, you could actually, you know, it mightn't be too arduous, this capital gains tax. Now the company, so that's you as a sole trader, has to pay that. Now the company has to pay stamp duty. Now stamp duty is 6%, so it's dear enough. Now scenarios. I have a few scenarios here. Let's say I'm a sole trader. So it's all about me today, Paula Byrne Accountants. All right, I'm a sole trader, and we'll just see that there's, I'll just answer a few questions here. So Jerry Crosby, if you voluntarily register for VAT and get a refund, can you then deregister later? Yes, you can, if you don't think you'll be over the registration limit. Yes, you can. But what they do is they do go back and they review certain things. For example, if you've claimed, they're quite strict, Jerry, like if you've claimed a refund on a van, for example, and there's a time limit, I don't know what it is off, and you've claimed it within, I think it's the last 6 months, so I'm guessing at that, it's around that, they'll be looking for that back. So it's only on certain things. But I have had clients in the past where I've advised them to deregister for VAT. And then again, when things picked up, this was in the last recession, when things picked up, they just re-registered. Martin Ryan, the difference between scenario 1 and 2 is that left in the company. What's the most efficient way of using this money? Use it to pay your pension contribution? Yes, absolutely. And do you know what I would say to you, Martin Ryan? And I'm a tax person, I love tax. I would say to you, don't make all your decisions in business based on tax, alrighty, as we'll see later. So you might need that money to, you know, for the rainy day, because this is the rainy day. But tax-wise, yes, that is correct. But I would just be frightened of, and I'm usually quite a risk, you know, person, but I would like to have, you know, keep a bit of rainy money somewhere. But yeah, you're quite right. Martin, I think the current slide section answers all my questions, but are there any other ways of using money rather than leaving it in the company? Any other ways of using the money rather than leaving it in the company?
So I think Martin is going back to that scenario. Sorry, Paula. I think Martin is going back to the scenario that you had that really good explanation. So his first question, you then went on and answered it in terms of pensions.
Thanks, Eilish. Okay.
But is there anything else, I suppose, any other alternatives that could be done in that situation?
So I suppose if the company, if you had extra money to spend, spend on something that's tax deductible to get the tax break on it. Maybe, as Tom said earlier, have a look at R&D, because there's great tax breaks going for that at the moment. Maybe you could expand, or anything you do that's going to invest in your company, you're going to get a tax break on it. So yeah, absolutely.
In terms of R&D, Paula, because I think sometimes when a business owner hears that, they think, God, that's the big multinationals. That's, you know,
it's me. I mean, I had a student there recently. He was asking me, and I actually didn't think he was going to get it. And he had a client who had developed an app. And I said, oh, no. But they got it. It was a great app.
Yeah. It
was an app. I'll tell you what it was, Eilish. It was an app to do with finding free available car parking spaces in Dublin. Okay. And it was a firm, now it is kind of specialised in claiming the R&D, and they went to a firm as big as, and it wasn't Tom's, but it was one as big as him, and they helped him. But it was well worth spending the money on that, actually. Yeah. I think, what about, sorry, Eilish.
Do you want to take more questions now, or do you want to do your scenarios, or what's your preference?
Well, I just go and answer a few of these, so then people can go and get their cup of coffee.
Yeah, lovely. Work away.
Yeah. So, what about travel and subsistence, sole trader versus limited company? Okay, so if you're it's the same. So if it's your travel and your subsistence is wholly and exclusively for the purpose of trade, absolutely you can claim it. There's no difference. I promise you there's no difference. Both can use civil service rates, you know, that's up on their website, or you can just keep the receipts. And as long as they're vouched expenses, then that's okay. Paula, what's the most tax efficient way to take profits out of the company? I'm going to talk about that in a minute, Jerry, so you'll have to wait and see. What is your view on succession tax? It's very high. Yeah, but there's ways about it. So hang on and we'll find out what that is. Okay, so I'm going to close this down now and go back to my scenario here. So I'm a sole trader and I'm Paula Byrne Accountants. And I've no assets, let's say. Now, this is fabulous. I think this is really good. So accept that, let's say my client list is worth 75,000. Now, how would you put a value on your client list? You probably look, and it depends on what kind of business you're in, but maybe you'll say, look, they'll generate this kind of turnover in the next 3 years. So you could do that. But anyway, let's just say I put a value of 75,000 on my client list. And then I incorporate. So I'm now Paula Byrne Limited. Okay, so my statement of financial position looks like this. On the first day that I incorporate, this is what it looks like. Now, what's a statement of financial position? So in the olden days, this used to be called a balance sheet. That's what it is. So at the top of your balance sheet, what are my assets? My assets are goodwill. That's basically what it is. It's my goodwill. These are my customers. And how is that financed? Financed by a loan from Paula Byrne. So I've offloaded my invisible asset, if you will, into Paula Byrne Limited. So that company, I've given it to the company. So the company owes me 75,000. I can take that 75,000 out of the company, because that's just a repayment of the loan. And I can take that out without any tax repercussions. And when are you going to have access to 75,000 tax-free? Okay, so remember, so you put a value on your goodwill, put it into the company owes you that, and then you can extract that tax-free. Now remember that when you incorporate, it is not without its tax consequences. So by me putting a value on that goodwill, when it goes into the company is buying the goodwill, and when a company buys the asset off you, that means that it has to pay stamp duty, and the stamp duty it'll be paying on that is 6%. When are you going to be paying 6% on something for 75,000? It's fantastic. All right, so look, I'll move on. I get very excited about that. I think that's a very good opportunity. So rather than going straight into becoming a limited company when you set up, think about becoming a sole trader first. When it's tax efficient to do so, then become a limited company. And remember that you have this scenario here, that if you put a value on your goodwill, which has to be independently valued now, you can extract cash tax-free basically. But for you to have put the value on the goodwill, the company has to have paid stamp duty of 6%. That's question number 2. And question number 3, I think Jerry was asking me there, cash extraction. Okay, so how can I take cash out of a company? You can take a salary. You can take a dividend. You can take a termination payment, or you can sell your shares. All right, so salary. If you take a salary from the company, you're going to be taxed on it. You're going to pay income tax, universal social charge, PRSI. But from the company's point of view, it's a tax. These are tax deductible expenses. Or you could take a dividend. If you take a dividend, and people always say, oh, is a dividend not a better thing to take? For you, for the taxpayer, there is no difference. You will be taxed income tax. You'll pay the exact same rate. The only difference is it's a different, what we call schedule, but it's the exact same treatment. But more importantly, from the company perspective, it is not a tax deductible expense. So this is, it's not as tax efficient to do this, unless, of course, you are trying to avoid a close company surcharge. Now, I might have gone a step too far there, but look, for the main part, know that a dividend is not a tax deductible expense. So a salary is better. Or you can take a termination payment. Now, what's a termination payment? A termination payment is when you're made redundant. Now, obviously, this is when you're on to exit out of the company. So a termination payment, this is above the statutory redundancy bit. So this is when the company pays you off. So for a taxpayer, there's an element that's tax-free. So the statutory redundancy is tax-free, but the extra bit the company gives you, there's something called a partial exemption. And you can work out what that is. It's the higher of a couple of different formulas, right? Put very simply. So you can work out, well, what is the tax-free element? And that's the bit you take. And for the company, it is tax deductible expense. Now, what I've neglected to put in there as well is you can also take expenses out of the company. So if you take expenses out of the company, and as long as they are expenses that you've had to incur by performing your duties, well, then they are not taxed. And for the company, they are a tax deductible expense. So let's say you live in Dublin and you had to go down to Cork to visit somebody on business. Well, then you can claim your mileage and all the rest of it. And that is another way of getting money out of the company. All right, you can sell your shares in the company if you incorporate it and you have shares. So from a company point of view, there is no, they don't care who you sell your shares to, the company is the same, but for your taxpayer, from your point of view, you will pay CGT. You don't have to sell all your shares, sell a few of them. Now the CGT rate in Ireland is 33%, so it's lower than the income tax, which potentially could be as high as 52%. And then you could qualify for some reliefs. You could qualify for retirement relief or entrepreneur relief. All right, so that's ways of getting money out of the company. Salary, dividend, expenses. And I know people can be very creative in getting expenses out of the company. And I would say to you that they must be business related for you to be able to do that. You can get a termination payment, or you can sell your shares. And they're the main ways. Now, succession planning. This is when you want to offload your business to the next generation. And they don't necessarily have to be your children. It could be anybody. All right, so regardless of whether you sell or gift your business, there is still a potential CGT liability. So I could offload Paula Byrne Accountants to my daughter Tara. I could gift it to her. She hasn't paid me a penny, and I still have a CGT liability. So be careful. So simply put, how do you work out your CGT liability? So let's just say the disposal proceeds are 500,000, or if I'm not getting money, I will take the market value, 500,000, less the cost of 50,000. I'm making these figures up, so don't ask me where I got the figures from. I'm just making them up. And that leaves me with a chargeable gain of the difference. And then you take away something called the annual exemption that you get once a year. And to be honest with you, it's not worth much. And that's €1,270. And then I pay tax on the difference, which is 33%. So whether I gift this to my daughter or sell it to her, I have to pay tax of €148,091. Hello. Okay, expensive. But there are reliefs available. And the two main reliefs are entrepreneur relief and retirement relief. Right. Now, and you have to do them in that order. So you must, if you qualify for entrepreneur relief, you have to take it. And then you can test for retirement relief. Entrepreneur relief. So gains on disposals of chargeable assets are liable to a reduced rate of 10%, up to an overall lifetime limit of 1 million. So basically all that is look, if you work out what your gain is, so my previous example, what was my gain? My gain was 448,000. I would pay tax on that at 10% if I qualified for entrepreneur relief, subject to a lifetime limit of 1 million. Right, and I haven't given you conditions for any other reliefs, but I am going to give them to you for entrepreneur relief and for retirement relief. The only two ones I've given you the conditions. It's not that hard to qualify for. So you have to own the asset for 3 continuous years out of the past 5 years. You must work in the company. So this applies also to sole traders. It's not just if you're incorporated. And when I say sole traders, remember farmers are sole traders too. Okay, so you must work in the company. You must work at least 50% of your time. There's no age requirement. Then you've got the limit. So if you're a company, you have to have 5% of the shares, and you must work for the business in a managerial or technical capacity. You don't have to be a director, and spend at least 50% of your time working in the business. Right? And if you're a sole trader, you've got to have owned the assets for 3 years out of the last 5 years. So it's not that hard. And it's only 5% of the shares if it's a company. Now, retirement relief gives you a potential complete exemption. You don't pay any CGT at all. But they make you claim the entrepreneur relief first. And then if you have any tax left over to pay, then you claim this, all right? So you're eating, so they're making you eat into your entrepreneur relief limit of 1 million. Anyway, you don't have to actually retire to claim this. So this, you have to be at least age 55 to qualify for this. Or if there are instances where if you're 54, they will let you claim it if you can prove you were very ill. Now, here are the conditions for retirement relief. You must own the asset for 10 years. If it's a company, you must be a working director for you must be a director for any 10 years and a full-time director for any 5 years. You have to be aged at least 55. And there's a limit. The limit is on the disposal proceeds, and it's 750,000 if you're 55, and it drops to 500,000 if you're age 66 or over. Okay, so So for me, my limit would be if my business is worth 750,000, happy days, you know, I don't pay any tax. But when I get to the age of 66, it's going to drop to 500,000. Now, it's different if you're offloading to the next generation. If you're offloading to your kids, there's no limit unless you're 66. Then there's a 3 million limit introduced. All right. Now, and there's other conditions there. Now, so they're the two main reliefs. Now, there's other exit routes to get out of a company. You can, the company can buy back the shares, or there are termination payments. Now, company buying back the shares, what's the story there? There's no problem. The company can do that as long as the company has adequate distributable reserves. In other words, as long as the profits are there, the retained earnings are there, they can buy back your shares. So if a company buys back your shares, how are you taxed on that? Well, if you satisfy certain conditions, you may qualify to be treated for CGT purposes and not income tax purposes. So for income tax, you could be paying up to 52%, and CGT, it'll either be 33 or indeed 10% if you qualify for the entrepreneur relief. And what are the conditions? Well, the headline condition is you have to have owned the shares for 5 years beforehand, and you have to be resident and ordinarily resident in Ireland. And the termination payments we spoke about earlier. Okay, so planning for succession, offloading to the next generation. You can either gift or you can leave it in your will for the next generation. Now, I'd always say, don't make decisions on this based on the cheapest amount of tax. Think about it. I think it's better personally. I think you should offload while you're still alive so that you're around to answer questions and to mentor them, right? However, it's useful to know that there's no stamp duty and there's no CGT on inheritance. So all the tax, the only tax that will have to be paid is capital acquisition tax. And here's the taxes involved. If I'm offloading to the next generation, I have a potential CGT liability. The person I'm offloading to has a stamp duty liability and also has a potential capital acquisition tax liability. And they are what are known as the 3 capital taxes. Now, if you remember nothing else from today, remember that there's no CGT and there's no stamp duty on death. So for you, if you want to offload to the next generation, it's cheaper for you to do it when you're gone. Now, stamp duty. There are some stamp duty reliefs, and they are to do with farmers. So unless it's a farm, you can ignore this. So they get young trained farmer relief or consanguinity relief. So the young trained farmer relief gives you a complete exemption to stamp duty, but revenue, consider anybody young. You've got to be 35 is the oldest you can be. And consanguinity relief is on land, and it just reduces it down to 1%, and it has to be from a blood relative. Okay, and then the capital acquisition tax. So remember now, CGT, stamp duty, CAT. Now with the CGT, there are reliefs available. And what are the reliefs that are available? Retirement relief, entrepreneur relief. Then we have the stamp duty, they're farmer reliefs. And then we have, and I don't mean that dismissively going, oh, they're just for farmers. They're for the farmers. And then we have capital acquisition tax, and that's paid by the parent. The reliefs available for them are agricultural relief and business relief, which I'll talk about shortly. So tax payable by a child on a transfer, and I've just picked a child as an example. So here is how you work out capital acquisition tax computation. So let's say they've received 500,000, and from that they can take away any expenses that they have to pay out of that gift. So they had to pay stamp duty out of it. And if it's an inheritance, they might have to pay funeral expenses. Okay, and then they get a threshold, and there's 3 thresholds, A, B, and C. So A is 335,000, B is 32,500, and C is 16,250. Now, it depends on who's giving you the asset to you. So from a parent to a child, it's A, from an aunt or uncle, from a sibling, from a grandparent, that's B, and from a stranger, it's C. So in this particular instance, I've picked a child, so it's 335,000, and it isn't a lot. It definitely is not a lot. And then they get the small gift exemption. You only get that if it's a gift. You don't get that if it's an inheritance. So potentially this child will pay capital acquisition tax, which is 33%, and that gives us €51,810. But there are reliefs available. Business relief and agriculture relief, and both of them, and we're nearly finished here, guys, I promise you. So business relief, both of them give a 90% reduction in taxable value. 90% reduction. So there are conditions that you need to satisfy, and you need to do a bit of planning around that, particularly on the agricultural relief, that you have to be an active farmer and you have to satisfy an 80% agri assets, and you have time to plan for that. And also there is a CGT offset. So let's say I'm offloading my business to my daughter, and let's say I didn't avail of any reliefs and I had to pay CGT. Well, then the CAT that she has to pay, she can utilize my CGT. She can use that and take it away and discount her own tax by the CGT that I have paid. Watch out for clawbacks. So there is a clawback of 6 years on agricultural relief, business relief, retirement relief. There's a clawback of 6 years, and there's a clawback on CGT offset of 2 years. So when you're going, my advice to you is call your accountant, your tax advisor. Don't just find out what the conditions are, ask about the clawbacks. So I think now is an opportunity to plan so that the conditions can be satisfied. So say to them, listen, what reliefs are available? I'm thinking of doing this. Right, and find out now what conditions need to be satisfied. So you're probably thinking, oh, listen, every time I phone my accountant, it costs me a fortune. Don't phone up and say, look, Harry, I'm just checking in with you. What's the story? And I'm thinking about this. How's the family? And the more they get to know about you personally, the better disposed they'll be to give you advice. That's my takeaway from today. So I think I've spoken an awful lot. So thank you very much for putting up with me and listening to me rabbiting on about what I think is one of the best subjects in the world. And so I know I come across a bit mad. So if there's any questions now, I'll be very happy to take them.
We've got plenty of questions, Paula, and thank you so much. Yes, you did talk a lot, but it was engaging, insightful, and really, really, really useful. I think even just judging from the questions coming in, you've definitely held a captive audience. So thank you so much for all of that. A couple of questions that we have. Noreen is just wondering, is it correct that entrepreneur relief does not apply to goodwill?
Oh, now, Noreen, that is a big area, all right? Now, it does in certain situations. In certain situations, it does, all right? So what I would advise you to do, that's very, very technical. And you know what I used to, because when I wrote my tax book, I actually referred to Tom's book there, and he answers that very well. So it is very technical, and in some cases, it does. But the takeaway would be, as long as it's not for the avoidance of tax, it's bona fide, yada, 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 all right? So, so I would say, is it correct that it doesn't apply? The answer is no, it can do in certain situations. Is the 75, do you want me to talk these through, or do you want to ask me, Eilish, because I can see them?
Whatever, if you want to take a breather to read them, and I can ask you if that helps you.
Yeah, go on, you ask me.
So Jerry is asking if the 75,000 goodwill is transferred from sole trader is taxed in your sole trader books.
Yes, it could potentially be the subject for CGT. Good question. But hopefully you will avail of incorporation relief, or you could avail of entrepreneur relief. So there's a few ways around that. Okay. But even if you do, Jerry, the worst scenario is it's and that would be the very worst scenario. You would have done very bad planning. You'd have to pay tax at 33%. But you're getting, remember now, you're getting this 75,000 and you're not paying income tax on it. So you'd be, I doubt very much, if you had a good planner there, you wouldn't be paying tax on it now, to be honest with you. Thank you, Eilish, sorry.
Okay, great. Thanks, Paula. Darren and Desmond and Nolene on YouTube as well have all been sending in positive comments about how easy you are to listen to and how interesting it's been. So echoing what I know to be true. Desmond is also wondering though, Paula, he'd one question. If he had IP as a self-employed individual, can he transfer to a limited company and capitalise the IP as goodwill?
As long as he had an independent valuer come in and put a value on that, absolutely. But it has to be a value, you know. Yeah.
Okay, great. Desmond, I hope that answers your question. Aoife, so Aoife's got an interesting business actually. It's a furniture company. Aoife's been with us from day one. It's a family business. So she was asking about your views on the succession tax before you went through it. And she's just asking, I suppose, a little bit more specifically regarding the next generation.
So if the next generation, so Aoife, if you want to
hold for 6 years.
Yeah, so the next generation has to hang on to it for 6 years, or else they have to repay the business relief they would have claimed on the business. And likewise, if you are offloading to so I don't know if you're the owner or if you're a daughter in the business, but let's say you're the owner, and if you are offloading to the next generation, you might have claimed retirement relief. Now, the next generation has to hang on to the business for 6 years, or else they have to repay the retirement relief that you claimed, not you. So there's on both sides. I hope that answers your question.
Great. And she's also asking with that business, and it's something that we've come across over the last couple of weeks, is can she change the business? So it's a bricks and mortar store at the moment, but could the next generation move it online? Would that have any implications in terms of the holding, or is that still okay?
No, fabulous. Yeah, absolutely. Yeah, no problem.
Okay, brilliant. And we have a couple of questions on YouTube, so forgive me, I'm going to go to my other screen. Helen has a question on YouTube about the knowledge development box, which is one of those R&D release, I think, isn't it?
Yeah.
She's wondering how long will it last? I think it's due to expire this year. Do you think?
Oh, it's Helen, is it?
Helen, yeah.
Yeah, Helen, they do that and they'll say it expires and then they just keep renewing it. That will go on and on and on. You think about it, we are trying to attract in the pharmaceutical companies into Ireland, and they've been very successful in doing that. And the knowledge development box was one step further, and my view is a long time, particularly as our corporation tax is coming under pressure, you know, the 12.5%. But if we can hang on to this, oh, absolutely. No, that's around personal opinion, but definitely.
Okay, brilliant. Thank you. Then we have Patricia as well on YouTube asking us if the exit routes that you talked about, do they apply to sole traders also?
Termination payment not, because you're not an employee of the company. But you can take retirement relief and you can claim entrepreneur relief. Yes, absolutely. So if you're young, claim entrepreneur relief, and it's not that difficult to apply for. And that means that you'll just pay CGT at 10%, fabulous. And then if you are coming up to 55, you can claim retirement relief and potentially you pay no CGT at all.
Okay.
And you can't sell back your shares, obviously, because you don't have any shares.
Okay, super. That is great. I'm going to ask you one more general question, if you don't mind, Paula, and it's really just in your...
And you're going to say this is a quick question.
This is a quick question for you. No, I suppose one of the things, you know, that we're all taking this kind of pause, and this webinar series is built around, you know, we did it very quickly to try and capitalize on that time that small businesses now have or may have, and to try and, I suppose, get the most benefit out of what is a crisis and what is a very unsettling time. So it's a chance for people to kind of think about how they do things. And one of the things with small business owners, as you know yourself, I don't know how you manage your schedule at all with all the things you're involved with, is that you're so operationally busy and just hectic. So I suppose, how engaged or how hands-on would you recommend a small business be with their accountant throughout the year in a normal
Oh my
situation?
God. I make great money from people, new clients coming to me because they say their accountant they only heard from their accountant once a year when the tax returns were due. All right. So, but that you have to take, so if that's the case, you might just have somebody who's shy. You don't know. So you contact them. And if they are the type of accountant that's going to charge you for every call, I don't think they will at the moment, but I would say check in with them and make a friendly call. Definitely be very, very, very engaged with them. So to the point where you kind of annoy them. Now, I use WhatsApp an awful lot and LinkedIn, and I would get called, and it's very simple for them to answer a WhatsApp question. You know, sitting down of a night, they look through it and they'll answer them. So yeah, absolutely engage with them.
Okay, brilliant. Thank you. And I think everyone is probably watching, wishing they all had an accountant that was as lovely as you, Paula. Vin is joining us a little bit on a lag, so he's watching us a little bit behind. So his question is going back a bit to, I think it was Martin maybe that asked it earlier. Let me check. No, sorry, it was Desmond. So he's just going back to Desmond's question about the IP valuation. And he's saying does it have to be an independent valuer who values the IP, as in the customer list in Paula's example also? Is that considered IP?
Yeah. Oh, yeah. Of course, you have to have an independent valuer. Yeah, because I could say, yeah, it's worth 5 million. Yeah, no, it has to be independent. Absolutely.
Okay. And is the customer list considered IP?
Well, IP, yes, and goodwill. Yeah, definitely. Yeah, you could consider it that. But for the purpose of my illustration, it would be capitalized as goodwill. And I suppose intellectual property would be a type of goodwill.
Okay, great. Thank you. So that's all of the questions that we have. Thank you so much.
But just in case he's wondering, does that qualify for the knowledge development box? No, it doesn't.
Okay.
Yeah. And just in case that was the question. Yeah, sorry, Eilish, I interrupted you.
Brilliant. Okay, so that's it, Paula. Thank you so much. Didn't I tell you it'd fly by?
It flew by, yeah, absolutely. Now, yeah, it did,
yeah. So it was really, really interesting. Thank you. All of the comments coming in, I mean, you'll see them there yourself when you get a chance to go through them, just on the clarity that you brought to what are very complex issues. So lots of positive feedback coming in on YouTube here, as well as from our participants on the Zoom webinar. So thank you, Paula, and thanks, of course, to Tom as well for his contributions earlier. Just two powerhouses to talk about tax, and I think demystifying is definitely what you both did today. So thank you very much. And to everybody else, we will see you on Monday for our final week of webinars. And until then, stay well and safe. Thank you very much.
Thank you very much.